Hey everyone! Welcome back to our YouTube channel Quantitative. Today we are going to discuss about an important topic, QE and QT. In first part we will discuss about QE. Before we get started, subscribe to our channel for more useful videos. Quantitative easing, or QE, is a monetary policy tool used by central banks to stimulate the economy when traditional methods stop working. Normally, central banks manage the economy by adjusting interest rates. But when rates are already near zero and economic growth is still weak, they turn to quantitative easing. So, what exactly is QE? Quantitative easing is the process where a central bank creates new money electronically and uses it to buy financial assets like government bonds from banks and financial institutions. This increases the money supply in the economy. At the same time, it lowers long-term interest rates, making borrowing cheaper for businesses and consumers. When borrowing becomes cheaper, businesses invest more, people spend more, and overall economic activity increases. QE also pushes investors to move their money into riskier assets like stocks, which can boost financial markets. Let's break down the impact. First, QE injects liquidity into the financial system. Second, it reduces borrowing costs across the economy. Third, it supports asset prices like stocks and real estate. However, QE is not without risks. One major concern is inflation. If too much money is created, it can reduce the value of currency and increase prices. Another issue is wealth inequality, because rising asset prices tend to benefit those who already own investments. There's also the risk of creating financial bubbles, where asset prices rise beyond their real value. In the United States, the Federal Reserve has used QE multiple times, especially during the 2008 financial crisis and again during the COVID-19 pandemic. These actions helped stabilize the economy during periods of severe downturn. Investors begin shifting their money into higher return assets like stocks and real estate, which can boost financial markets and improve overall confidence. But QE isn't a perfect solution. If used too aggressively or for too long, it can inflate asset prices beyond their real value, creating bubbles. It can also increase wealth inequality, since rising markets tend to benefit those who already own assets. And if liquidity grows faster than real economic output, it can lead to inflation over time. The Federal Reserve has used QE during major crises, including the 2008 financial collapse and the COVID-19 pandemic, to stabilize markets and support recovery. So the next time you hear about the Fed injecting liquidity, you'll know exactly what's happening behind the scenes. Subscribe for the next part and to get more clear and powerful